Looking back, we entered 2023 with a pessimistic consensus outlook for U.S. economic performance and for how rapidly inflation might recede. How did 2023 turn out, and what were the economic strengths and weaknesses? The big economic driver in 2023 was job growth. Jobs had recovered all the pandemic losses by mid-2022. And despite the rapid pace of interest rate increases, jobs continued to post strong growth in 2023, partly due to many people returning to the labor force. When the economy is adding jobs, people are willing to spend money. So the key for real GDP in 2023 was the strong job growth leading to robust personal consumption spending. For 2024, labor force growth and the job growth are anticipated by many to slow down from the unexpectedly strong pace of 2023. That may lead to slower real GDP growth in 2024. There's still plenty of debate about whether a slowdown in 2024 could turn into a recession. Followers of the inverted yield curve will point out that it was only in Q4 2022 that the yield curve decisively inverted. That is, short-term rates higher than long-term yields. It may take 12 to 18 months after a yield curve inversion for a recession to commence. Using that math, Q2 2024 would be the time for economic weakness to appear, based on this theory. Time will tell. The rapid pace of inflation receding in the first half of 2023 was a very pleasant surprise. Indeed, inflation is coming under control by virtually every measure except one: shelter. The calculation of shelter inflation is highly controversial for its use of owner equivalent rent, which assumes that the homeowner rents their house to themselves and then receives the income. This is an economic fiction that many argue distorts dramatically the headline CPI, given that owner equivalent rent is 25% of the index. Once one removes owner equivalent rent from the inflation calculation, inflation is only 2%, actually right on top of the Fed's long-term target. The bottom line is that monetary policy reached a restrictive stance in late 2022 and was tightened a little more in 2023. For a data-dependent Fed, the inflation and jobs data for 2024 will guide us as to what might happen next. Good numbers on inflation, or unfortunately a recession, might mean rate cuts. Otherwise, the Fed might just keep rates high for longer.